Meet Tom. Tom is not a billionaire. Tom is just a regular guy with $20,000 sitting in his Chase savings account. Money he worked hard for, sacrificed for, told himself he was being responsible, being smart, doing the right thing. And every single month, he opens his banking app and sees the same thing. A tiny interest payment sitting there, sometimes 40 cents. Sometimes $1. Last month, it was 73 cents. Tom stares at that number and feels something he cannot quite name. Not quite anger, not quite confusion. Something sitting uncomfortably between the two. Because on that same day, Tom's bank announced its annual profits, $54 billion, in a single year, from the same money that just paid Tom 73 cents in interest. The same institution, the same deposits, the same system, $54 billion on one side, 73 cents on the other. And if you have money sitting in a savings account right now, I need you to stay with me for the next 15 minutes. Because what I am about to show you is not a conspiracy theory. It is not clickbait. It is literally how the banking system was designed to work. And once you understand it, you will never look at your bank account the same way again. Stay until the end, because I am going to show you exactly what Tom did to flip this entire system in his favor. And it takes less than 20 minutes to set up. Here is something your bank will never put on their website. The moment you deposit your $20,000, that money stops being yours in any practical sense. I know that sounds insane, but let me prove it to you. Legally, when you deposit money into a bank account, you are now a creditor of the bank. You have lent them your money. They have promised to give it back whenever you ask. That is the entire relationship stripped down to its core. You are the lender. They are the borrower. And like every borrower in history, they are going to use that money to make themselves as much as possible before they eventually have to return it. Most people picture their money sitting in a vault somewhere with their name carefully written on a little box. A safe container of cash waiting patiently for them to return. That image is comforting. It is also completely wrong. The moment your deposit clears the bank, puts that money to work immediately and aggressively. And the returns they generate from your money compared to what they pay you back in interest is one of the most profitable arrangements ever quietly constructed in the entire history of finance. The bank is not keeping your money safe out of kindness. They are keeping it because your money is the raw material that powers their entire business. Without your deposits, they have nothing to lend. Without lending, they have no interest income. Without interest income, they have no $54 billion annual profit. You are not their customer in the way a restaurant has customers. You are their supplier, and suppliers historically get paid as little as possible. Now here is where it gets genuinely extraordinary. Tom discovered something called fractional reserve banking, and it stopped him completely because of how simple and how world-altering it was at the exact same time. Here is exactly how it works. Tom deposits $20,000 into his account. The bank is legally required to keep only a small fraction of that deposit in reserve, roughly 10%. That means the bank keeps $2,000 in reserve and immediately takes the remaining $18,000 and lends it out to someone else. That someone else deposits their loan into their own bank account. The bank then keeps 10% of that deposit and lends out the remaining $16,200 again to another borrower, who deposits it, who the bank lends out again, and again, and again, each cycle keeping 10% and deploying 90% right back into the lending system. Follow this chain all the way through, and Tom's original $20,000 deposit can generate over $180,000 worth of loans circulating through the banking system simultaneously. The bank did not find extra money from somewhere. They manufactured it mathematically from Tom's deposit using a process that has been completely legal and standard practice for over a century. Tom deposited $20,000. The bank transformed it into $180,000 worth of interest-generating activity and paid Tom 73 cents for the raw material that powered all of it. But lending through fractional reserve banking is just the foundation. Here is what the bank actually does with your money once they have it in their hands. They lend it to mortgage customers at 4 to 6% interest. They lend it to personal loan customers at 10 to 15% interest. They lend it to credit card customers at 20 to 29% interest. They invest portions of it in government bonds and financial instruments that generate steady, reliable returns. They fund entire investment banking divisions that generate billions in additional fees and commissions on top of all the interest income combined. Every single one of those activities generates returns measured in billions every single year. And your savings account, sitting right in the middle of all of this, is earning somewhere between 0.01% and 2% depending on where you bank. The average Chase savings account pays around 0.01% right now. Even the best high-yield accounts at online banks push it to 4 or 5%, but the vast majority of Americans are not in those accounts. The gap between what they pay you and what they charge everyone else to borrow your money is called the net interest margin. It is the single most important number in banking, and it is the engine that generates every single penny of that $54 billion annual profit. Tom did the math slowly and carefully. He was earning 1% on his $20,000, $200 a year. The bank was lending that same money to credit card customers at 29% and keeping the 28% difference entirely for themselves. Tom was not the customer. Tom was the product. Now here is where it gets truly dark. And this is the part that made me the most angry when I first understood it. The average American credit card charges between 20 and 29% annual interest. Some store cards and subprime credit products charge rates above 35 and even 40%. These products are not primarily marketed to wealthy people who pay their full balance off every single month and never pay a cent in interest. They are marketed aggressively and specifically to people who are already financially stretched, people who are most likely to carry a balance month to month, people who are most likely to make only minimum payments, people who are least able to afford the compounding interest that quietly doubles and triples the original amount borrowed over time. Here is a real number. Someone borrows $2,000 on a credit card at 29% interest and makes only the minimum payment every month. By the time that debt is fully cleared, they will have paid back over $4,200 on an original $2,000 loan. The bank doubled their money from a customer who was already struggling financially, and they did it using deposited money from customers like Tom that they acquired for 1% or less. The machine is perfectly designed. Wealthy depositors keep savings in accounts earning almost nothing. The bank uses those savings to fund loans to people with less at extraordinary interest rates. The wealthy depositor loses purchasing power slowly through inflation. The struggling borrower pays interest rates that make their financial situation progressively worse. The bank sits in the middle of both transactions, collecting the margin from both sides simultaneously, and then announces $54 billion in profit. Banks spend hundreds of millions of dollars every year on advertising to make their savings accounts feel like a generous gift. Special rates, bonus interest for the first 12 months, limited time offers, loyalty rewards for long-term customers. The language is designed carefully and deliberately to make you feel like the bank is doing you a personal favor by holding your money and occasionally returning a small portion of what they earned from it back in your direction. But here is the reality the advertising never mentions. Right now, inflation in the United States is running at roughly 3%. If your savings account is paying 0.5%, you are not making money. You are losing it, slowly, quietly, every single month. Your numerical balance is going up, but its real-world purchasing power is going down. The number increases, the value decreases, and the bank knows this. The entire system was structured this way deliberately. Tom did the math. $20,000 in a standard savings account at 0.5% over 10 years becomes $21,023 in nominal terms. But after 3% annual inflation, that same balance has the real purchasing power of just $15,600. He did not grow his money. He lost $5,000 in real value while thinking he was being responsible. Tom looked at his savings account with completely different eyes. What he always thought of as a safe and sensible place to grow his money was actually a slow and politely engineered mechanism for making him gradually poorer while making the bank measurably richer. Tom closed his laptop and sat in silence for a long moment. Then he asked himself one question that changed everything. If the bank takes my money and generates extraordinary returns by deploying it across mortgages, loans, credit cards, bonds, and financial markets, what is stopping me from doing exactly the same thing myself and keeping all of the returns instead of handing them to the bank? Nothing. Absolutely nothing at all. Every single tool the bank uses to generate wealth from deposited money is available to any ordinary person with a smartphone and a free brokerage account. The bank invests in government bonds. Tom can buy treasury bonds directly at treasurydirect.gov, currently paying over 4.5% annually. The bank invests in diversified financial markets across thousands of companies and dozens of countries simultaneously. Tom can do exactly the same thing through a low-cost global index fund like VTI or VXUS with an annual management fee of less than 0.2%. No financial advisor, no commission, no minimum balance beyond whatever he chooses to invest. The difference between what a standard savings account returns over 20 years and what a simple global index fund has historically returned over the same period is not a marginal rounding error. It is the difference between a life that stays roughly the same and a life that changes completely. $20,000 in a savings account at 0.5% over 20 years becomes $22,100. $20,000 in a global index fund at a historically average 7% annual return over 20 years becomes $77,394. That is a $55,000 difference from one single quiet decision made on a Tuesday afternoon. Tom opened a brokerage account at Fidelity. He transferred his $20,000 out of his Chase savings account. He invested it in a low-cost index fund. He spoke to no financial advisor. He paid zero commission. And if history is any guide, that single decision will generate more real wealth over the next 2 decades than his savings account would have produced across his entire lifetime. Tom still has a bank account. He still uses it every single day for direct deposits, bill payments, subscriptions, and his general financial life. The bank is a tool, and tools are not the problem. Using any tool without understanding how it works and who benefits most from the arrangement, that is the problem. But Tom no longer leaves his savings sitting in a checking account generating nothing. Tom no longer mistakes a savings account for an investment strategy. Tom no longer confuses the feeling of safety with the reality of actual long-term growth. Because he now understands clearly and permanently that the option that feels the safest and the option that genuinely is the safest over the long run are almost never the same thing. The bank made $54 billion last year. A significant portion of that profit came directly from the gap between what they paid depositors like Tom and what they charge borrowers on the other side of the exact same transaction. Tom used to sit unknowingly and contentedly on the losing side of that gap, earning 73 cents a month, feeling responsible, feeling safe. He is not on that side anymore. And now, neither are you.